So I'm not a gold bug, but I am I am a quick study of the financial markets. And I can tell you that gold does exceedingly well in times of deflation and inflation, which is actually not something that is appreciated, but it's one of these things called data, so it's undeniable. But what gold is, and I've learned this as being a reformed former central banker, is the only place that you can hide when every single asset class in times of crisis lines up and correlations line up perfectly and they're all moving in tandem. Gold and silver are the only place that you can possibly hide.
Welcome to Coffee with Lynette. Today's extraordinarily special guest, I'm so excited about this, is Danielle DiMartino Booth, who earned her MBA. I mean, her credentials are stellar. She earned her MBA in finance and international business and her MS in journalism from Columbia. My brother actually went to Columbia as well. She started her career at Credit Suisse and then Donaldson, Lufkin, and Jenrette. And she worked in fixed income, private equity, which would be public stocks, public equity, which would be the stock market, as well as private equity. And then she moved to Dallas and she became a financial reporter for the Dallas Morning News. After that, because of her wonderful work, she was discovered by the Dallas Fed, and it's wonderful because she was the first non-PhD to actually be a part of it because she finally had some real life experience into the hallowed halls of the Dallas Fed. Though I will say that as an advisor to Richard Fisher, he too came from that street background, and that's what the Federal Reserve really needed. So she was there for 9 years until he retired in 2015. And she has definitely earned a reputation for bold predictions based on absolutely meticulous research, which is one thing that is, as you all know, very near and dear to my heart. And so she actually, through that research, she actually brought a lot of life to the Fed. She is absolutely a global thought leader on monetary policy and economics. She has founded Money Strong LLC in 2015, and she publishes a weekly newsletter that is a must read. She's a full-time columnist inside of all of that. She's a full-time columnist for Bloomberg View. She's a business speaker, a commentator. She's been on CNBC, Fox News Network, Fox Business. I mean, she is all over the place. And as a mother of twins and with 2 other children, 3 boys and a girl, she's a very busy woman. But she's also a senior economic advisor because what's on her plate's not enough. And I resemble this remark. That's why I'm smiling with it. But she just became a senior economic advisor to the Commerce Street Capital. So what I love about her is that she puts research first. She has been in the trenches. She knows what that's like. And she brings real life experience to these issues that we really all need to understand. So with that, I'm going to stop talking because what I really want you to see here is the book that she wrote, Fed Up, and it's an insider's take on why the Federal Reserve is bad for America. And I hope you don't mind me overstepping this a little bit, Danielle, because I love the dedication in your book, and I thought that maybe we could use that as a dedication for the interview today. So she says, I dedicate this book to every hardworking American who wakes up in the morning asking themselves, what went wrong? Welcome, Danielle. Thank you for being here today.
Thank you for starting with my dedication. I've made Penguin Random House very frustrated because every single book signing that I have done since the book comes out, I sign my autograph on the dedication page just in case anybody misses it. I believe in my heart that they're the most important words in the entire book. And I will tell your watchers and your listeners how I sign my name, which is why my book signings take so long. And that is, don't ever stop asking questions until you get the right answers. And I believe that marrying my dedication to that unwavering quest for the truth is the secret to financial literacy in our country today.
Oh, boy, do I agree with that 100%. So thank you for that. And I guess that takes the first question is, why really do you do this work, and why did you write this wonderful must-read book?
Well, I felt that after, when I first joined the Fed, I had predicted the housing crisis. I was not exactly a fan of Alan Greenspan's, but my father had taught economics and finance. I was still reverent of the institution. I was still surprised that I'd even been invited into the sanctum sanctorum. And a few years into the crisis, I began to understand that there was nothing mysterious about where I was. There was nothing to be revered. There was nothing to be feared. But what there was a very dysfunctional institution that had a tremendous amount of direct, not indirect, direct control over my life, over the life of every American, yes. And that they hid behind this screen of big words and models and kept out the average layperson, working man and woman, with this jargon, and there was nothing mysterious about it. So I decided to rip the curtain back and write the truth in plain English so that everybody could understand, again, the direct role that these overly intrusive individuals have played in their financial well-being and in their retirement futures.
Well, I agree with that. My personal mission is to translate financial noise into understandable language. So this is perfect. Now, you said that the Fed exists so the American public can have confidence in the monetary system. Well, why does this confidence matter? And why do you say that the Fed is bad for America?
Well, I think that part of the problem has to do with the fact that Fed policymakers, the ones who are in charge, the ones who have permanent sway and vote, who are unelected individuals, they're unelected officials, that at the core of the problem is the fact that they're not on the receiving end of the policies that they make. They have health care for life. They have pensions for life. And we're talking about platinum-plated health care here and pensions that will make them very comfortable. And yet they see fit to do things such as reduce the federal funds rate to zero, to the so-called zero bound, which basically punishes hardworking people through what they're not making on their savings. And so it's very simple to me. Policies like that are bad for the country. Our yes. forefathers intended for us to be individuals who worked hard and saved today to invest for tomorrow in productive economic ventures, industries, and Federal Reserve policy has encouraged us to do the exact opposite, to live off of debt for today and not invest in tomorrow. And I don't think there's any gray area there. The way the Federal Reserve has been run since Alan Greenspan came to office, August the 11th, 1987, has been bad for America.
Yeah, I would agree with you. And they're talking about going below the zero bound or going into cryptocurrencies so that there's no restrictions on how low they can push interest rates and how quickly they can transmit their policies to the real world. What do you think about that?
Well, I think I'm really, really happy, and I'm not making a political statement, but I think I'm really, really happy that the two most recent appointees to the Fed, that would be reappointed Jay Powell, that would be newly appointed Randy Quarles, have both come out against the Ken Rogoff school of thought that advocates for monitoring our purchases, that advocates for negative interest rates, that advocates for the eradication of cash. Two of the newest people there and two of the strongest voices are absolutely opposed to any such thing. They've come out publicly and said, if for matters of national security, because Russia, Venezuela, China, they have already begun to implement their own sovereign cryptocurrencies. If for matters of national security, we have to play defense and make sure we also have a place on this stage globally, any transaction that occurs electronically will be as anonymous as if the two of us exchanged a $1 bill, equally anonymous.
How do you think they can do that, since everything has to go through a network? And part of, especially, you know, I'm referring to the IMF now, which of course I know you're really familiar with, but you know, they want everything valued in SDRs, and they, you know, and they want everything in cryptocurrencies, so you can have a lifetime tax. They can tax your income for life.
Well, again, I at least try and retain hope, because we're not a socialist state, and we still do retain reserve currency status, and the world still needs our debt. I understand that our taking on debt is the worst personification of a lack of discipline that we've ever seen. But for the moment, there is absolutely no alternative. The United States remains the most attractive horse in the glue factory. So as long as we retain economic sovereignty over the rest of the world, the IMF can take their ideas and put them somewhere else.
Well, I'm going to stand by you, because I actually do retain hope too. And I'm thinking that if enough people understand what their intention is, and they are aware that we understand what their intention is, they won't be able to get away with it. But you were, one of the things that I noticed in the book was you took me right back to 2008. And, you know, I could see everything that was happening. It's so well written. But you were really in the thick of it as an advisor to President of the Dallas Fed, Richard Fisher. Do you see any parallels between the lead up to that crisis and where we are today?
Well, the most obvious of the parallels would be leverage.
Yeah.
When 2007 ended, there was $150 trillion in debt worldwide. And today there's upwards of $230 trillion of debt worldwide. We have not just come through some fairy tale unicorn period of deleveraging at all. What we have done is try and resolve an issue that is grounded in being overly indebted with more debt.
Yeah. And also, since you're talking about that, it was the derivatives and the shadow banking system that created that lack of liquidity in the last crisis. And when I'm looking at derivatives, which are those big bets, and maybe you can explain a little better than me, it seems to me like what they've done with the netting and the different new accounting techniques is just hide the leverage rather than reduce that risk. What do you think about that?
I found it to be very curious last year when Janet Yellen, bless her heart, was in London and managed to say that she didn't envision another financial crisis occurring in our lifetimes because the banking system was so much sounder than it had been going into the crisis. And obviously I was not invited to be part of the audience, but had I been in the audience, I would have tentatively, no, maybe not tentatively, but I would have raised my hand and asked the question whether or not she distinguished between leverage that is built up in the capital markets vis-a-vis leverage built up in the banking system. And just because it was not in conventional banks, if therefore it was less toxic. That would have been the question that I asked, because the debt buildup has indeed occurred. It just hasn't occurred in the same exact place. So it's not, again, the conventional banking system that's at risk in the United States, as Deutsche Bank in Germany has communicated to us loud and clear. The worldwide conventional banking system is still in a very fragile state, plagued by derivatives, plagued by shadows on their balance sheets, and we don't know what the contagion effects could possibly be to our economy. But yes, Chair Yellen was correct. She refused to ever be called chairwoman, which I found to be very distressing. Chair Yellen was correct in that our conventional banking system in the United States was safer than it was going into 2007, but that does not mask the dangers of debt, period.
Right, right. And really, it's what do banks know? They know debt and they know leverage. And, you know, they're spending time just making it look nice, but that doesn't take the risk away. And especially when you look at the leverage ratio of Deutsche Bank, which at 3.8 means what, they borrowed $27 to generate $1 worth of equity. And, you know, I mean, that is so extremely leveraged, and we aren't really talking about all the leverage that's hidden in those derivatives. So, and they are systemically the most important bank on the planet, being a global universal bank and interconnected to every other financial firm in the world. You know, the other thing that I wanted to really, I mean, I think that, okay, so the derivatives that are based on interest rates in this environment, what do you think is going to happen with them? Are we going to see a derivative event? And what about those legacy derivatives that were never resolved during the crisis?
Well, I'm not going to pretend to be any smarter than I am. So when it comes
You're pretty smart.
Well, thank you very much. When it comes to legacy derivatives, you're going to come up with a big goose egg in terms of my being able to prognosticate what's to come. That being said, I think that the recent experience with the Italian bond market, which few people appreciate, is after the United States and after Japan being in the second largest position, the third largest sovereign bond market in the world. I think that after investors have seen how very sensitive to the slightest upset, the slightest disruption, interest rates are in other countries, that they should be aware that you could have an event in the derivatives market, again, that does not emanate from U.S. shores. I don't think necessarily that the next crisis, that the nucleus of the next crisis will necessarily be in the United States. The Europeans have been so much more aggressive with their money printing that it could definitely start over there, but it doesn't matter because of the world's reserve currency status. There's $11 trillion in emerging market dollar-denominated debt. There's an additional $11 trillion in dollar-denominated debt in the emerging market shadow banking industry, such that equates to 1/2 of the $50 trillion in dollar-denominated domestically housed debt. All I'm saying is reserve currency status has actually made the United States more vulnerable to its own currency.
For those viewers that are not familiar with shadow banks, could you just explain that a little bit, please?
So think of, for example, and this will be the easiest example. I don't know if many of you remember back in the day when Maria Bartiromo used to interview Angelo Mozillo, who was the CEO of Countrywide. He was that strange orange. I
remember that.
He was orange on your screen. So Countrywide was technically part of the shadow banking system that was underlying mortgage lending in the United States. In other words, the Federal Reserve didn't directly regulate Countrywide, but it was definitely a huge player in terms of providing lending if you looked at the entire lending picture holistically. In that same sense today, some of these massive private equity firms like Blackstone, like Apollo, they actually control more of the bond inventory than traditional banks used to because of the boneheaded direction that Dodd-Frank took and the size of the shadow banking system, if you will, that is not technically regulated by the things you read about, the OCC, the SEC, the Fed. Again, it is in the shadows because it is out of the reach of American regulators, but that does not make it any smaller, and it certainly does not make it any less capable of releasing contagion to what we consider to be the conventional banking system that you see when you drive down the road and see a Chase Bank or a Bank of America.
Yes. Thank you. That's awesome. And so I want to continue on talking a bit about emerging markets. And creating dollar-denominated debt, because in 2008, the yen carry trade was a big part of the global collapse. And so would you explain what the carry trade is, and do you see any parallels in what's happening with the U.S. dollar? I mean, the U.S. dollar took over as the carry trade from the yen carry trade. Could you maybe go into that a little bit, please?
Well, actually, the yen carry trade is alive and well.
Oh, good. Okay.
The yen is still considered to be the second safest flight to safety destination, if you will, in the global financial system. But what people look to do with carry trades is to find a currency where they can get more return on their money and make the bet in that currency such that they kind of get a double return, not just a return on the risky assets underlying their investment choice, but also getting a pickup because they're choosing to put it in a currency that yields more than anything else that they can find out there.
So do you see the dollar carry trade beginning to break down now?
I think investors focus since January the 26th, when the broad markets hit their peaks. I think that the public's focus on the VIX index, I don't know if you've spoken about it. I think that the public's focus on the S&P 500 volatility index is misplaced. My focus is actually on a different index called the MOVE index, and that is a sister measure of volatility based on our bond market. Remember, the bond market is multiples of the size of the stock market here in the United States and globally.
Yes.
And MOVE is easy to find. Google it, MOVE. It's real easy.
I definitely will, because I'm not familiar with that. So thank you very much. I mean, I'm learning a lot today, and that's one thing I will definitely be paying attention to. But you talked about the yen being, a safe haven trade. What do you really think? What is the safe haven trade, and what really is the safe haven?
Well, until there's an alternative, the only safe haven will be the U.S. dollar and the U.S. Treasury. We have negative interest rates in Europe. Again, just because you're the most attractive glue just because you're the most attractive horse in the glue factory doesn't mean that you're hanging out in a glue factory. It's that China has not been able to rise up as an alternative to the dollar because they've tried to impose communism and capitalism at the same time. They happen to conflict with one another, so it's been a rough go for them, and they haven't been able to get anything north of 1.5%, 1.8% of global trade volume in their currency. So it isn't that the United States is necessarily deserving of the status that it has, but it's that there's nobody else that's been able to rise up as an alternative because every other central bank on planet Earth has followed in the Fed's lead in trying to print their way to prosperity by creating debt. It doesn't work.
No.
And we actually started to raise interest rates way before even, for example, the European Central Bank has concluded growing their balance sheet. Again, we're just so far ahead of the game, as sickly as we are. It is what it is because the other players on the world stage are weaker than we are.
Yes, but could it also be, when we're talking about a safe haven, what are central banks doing? Well, since the crisis, they've been buying a lot of gold. So
some central banks have, some countries have. Some countries have done it, again, as a matter of for military type purposes. Germany has been repatriating quite a bit of its gold, but at the same time, Germany has been, for the first time since the Cold War, rebuilding its military presence. And these are the things that force me to teach my children, not personally, but all four of my children have taken Mandarin since the age of 4. And these are the nuclear options that as a mother you must pursue, because as unlikely as the event is in terms of probabilities, in the event that there's any kind of a fresh crisis, the real risk is that a currency war that cannot be won.
Right.
And China may be beginning to discover that they can't win a currency war, that they can't force the yuan to supersede the reserve currency status of the dollar. And a lot of times in the history of the world, when currency wars fail, they become hot wars. And that is a real risk.
Right. So what do you mean by hot war? Would you tell us more about that?
Hot war means war where you're putting people's lives on the lines, a true war.
Mm-hmm.
And that is how the British pound currency, which is the last reserve currency to have held for many, many, many years, actually fell. It was during times of war and during times of being overly indebted. But again, the dollar was rising while the British pound sterling was falling. And there has to be a sense of deep frustration in Beijing because they've not been able to force the yuan to rise and the dollar to fall.
Well, I think it's a really interesting mix that we have going on with all of these currencies. But, there's so many rules that were bent and broken and destroyed, really, and changed and created during 2008. And you made mention of this, and it got me to thinking, exactly what are the limits that you see on the Fed authority?
So I have this discussion more often than any discussion at all. And that is what happens upon the event of the next crisis, because it is actually the most important question that you can ask. The answers that the dovish Keynesian camp will offer are that there will be a full-blown debt jubilee, and that all debt will be forgiven, and that it will be an elegant solution that is pursued politically rather than by central bankers, because it would be a matter of sovereignty at that point if you were to relinquish the sovereignty of your banking system. And that is the only thing that I have heard people offer up as a solution to the next crisis, because at some point you have to realize that God himself is not going to come down from heaven and write the check.
Right.
And if you consider how very angry, and rightly so many Americans are, so many young people in France are, so many young people in Italy are, as to the station that they have found themselves in because people have decided to take on debt rather than invest in education, rather than invest in lasting productive endeavors, you'd have to get past the pitchfork crowd in order to make any kind of a debt jubilee work. And I'm not so sure that our politicians today have that kind of rope, have that kind of leeway. Truly, I don't know. These are bigger questions than anybody who's as humble as I could possibly ever answer. But we do know that in the world's history, there have been revolutions, and that revolutions have inherently been housed in economic inequality.
Yes, and that's really been a big part of the Fed policy, even though that's not a stated policy, but the result of their actions and their moves.
Absolutely, it has been. And the sad thing is, especially when I was on the inside, it was like beating my head up against a brick wall. I used to say, the wealth effect's right up there with the tooth fairy. There's nothing that's going to trickle down. You're going the wrong way. It was like that funny scene in Planes, Trains, and Automobiles when John Candy's driving down the highway, going down the highway the wrong way in the middle of the night. The people are on the other side of the highway are saying, you're going the wrong way. I did that for years, and there was still this very blind faith in the academic statistician, PhD type models that insisted, despite the fact that reality was suggesting otherwise, that insisted in trickle-down wealth effect. Again, at some point, you have to wonder if people inside the Fed, and I think Jay Powell have picked up a newspaper and read that the idea of the wealth effect has fabulously failed.
Yes, yes. But you also said in your book that what does trickle down are the effects of a collapse, or the effects of it getting tight at the top.
Well, that's the problem with Fed policy, that temporarily disrupts business on Wall Street, but makes sure that by trying to address what they call Main Street's dilemmas and challenges, actually gets Wall Street back up and running years before it has any effect of any benefit on Main Street.
Right, right. But you're preaching
to the choir.
Exactly. Now, I listened to some of your interviews with Greg Hunter, and you said that gold could go parabolic, like a hockey stick. How do you think that gold and silver would perform during this next crisis coming up?
Well, I'm not a gold bug, but I am I am a quick study of the financial markets, and I can tell you that gold does exceedingly well in times of deflation and inflation, which is actually not something that is appreciated, but it's one of these things called data, so it's undeniable. But what gold is, and I've learned this as being a reformed former central banker, is the only place that you can hide when every single asset class in times of crisis lines up and correlations line up perfectly and they're all moving in tandem. Gold and silver are the only place that you can possibly hide.
Exactly. And because that is actually savings, that represents savings, and that represents full use across every single area of the economy. So for me, I believe that that is really the only true safe haven asset. It's not an end-all be-all, but it will protect you during the next crisis.
I would agree with that.
Well, and the other thing is, you know, people always think that they're going to know 1 second before something happens and they would have a choice. So they try and ride this bull. Every week I do a segment on insider trading with the CEOs, CFOs. I just pull it from the Wall Street Journal. It's easy to do. And we can see that the insiders have been selling out in droves. I haven't looked at it yet for this week, but yesterday, or rather last week, insider selling was up about 2.5 times. So what do you think that might tell you? And I saw a shift in the pattern last October. I look at patterns a lot, and I saw a major shift in pattern last October that I've been talking about. But what does that tell you, how close we might be to a crisis? I mean, do you think that could happen anytime?
Well, last October happens to coincide with the automobile industry slipping into recession. So if I'm Joe, and this is prior to Hurricane Harvey landfall. So if I'm Joe Q CEO, I'm studying not the economic data releases that come with tremendous lags. I'm studying the real-time data that's showing me that America's sliding into recession. Now, if you pump $306 billion of insurance proceeds into an economy, a record level of insurance proceeds from Harvey, Irma, Maria, and 2 major wildfires, yeah, is it going to temporarily pump up the economy? Well, of course. Again, that's just math. But then you actually followed that up with the fact that the dollar was weak, and Trump started talking about trade wars and tariffs, which pumps through panic buying on companies' parts. But again, if I'm Joe Q CEO, if I'm Joe Q CFO, I read right through this and understand that it's temporary. And if my stock price is trading at a record high, I'm making sure that my net worth is secure.
Exactly, exactly. And, you know, just kind of staying on that path, what about the change in the tax laws as well as the repatriation? I mean, that was definitely done to keep this market moving up, since it's the most expensive market in the world, or that's in history, I should say, actually.
Well, I don't think Trump is naive enough to think that some of the money was not going to flow back into share buybacks. But I do think that he may have drank enough of his own Kool-Aid to also think that it was going to be in sustainable capital expenditures. And that is a to be determined type situation. Again, it's not so much that the intent wasn't there and that the intent itself was not somewhat noble. But go back to the C-suite and the perspective of people making decisions on long-term investments. And do you make investments when assets everywhere are the most overvalued they've ever been at? Or do you keep your powder dry and wait until assets are at fire sale prices?
Exactly. And that's part of the strategy that we actually execute here, just based on repeatable patterns. So, yeah, absolutely. But, you know, what do you think about just the normal public thinking that they can get out right at the right second, just before something collapses? Because that's what most people think.
I want to be them. I want to be perfect. I love it. I think that's quaint. I think that's lovely. All we know is that index investing and the ETF revolution has made the size of the entrance into these markets that people perceive as being liquid. The size of the entrance we know to be approximately, give or take, infinity. And the size of the exit we know to be a complete unknown. And so that is one of the most frustrating aspects of mom and pop investors, is that they think they've bought into these really quote unquote cheap investments because the fees associated with them are so very low, but they don't understand that they'll be ravaged with capital losses that more than offset anything they could have ever saved in fees.
Yes, exactly. It's really dangerous. I mean, but your newsletter probably does address a lot of these things, right? Because you do it every week.
I do. And actually, I've just founded another company because I found that I didn't have anything to do between 2 and 4 a.m. And
oh, God, you're so much like me. It's ridiculous. Go ahead.
Well, what I found was that my regular Money Strong weekly newsletter, which is, it's trended very well. It's been very well received among institutional investors, but I found that the price tag was too high. So as an alternative to sleep, I decided to roll out the Daily Feather. And the Daily Feather is $25 a month, and it's been up and running for approximately 7 days. And the uptake has been tremendous. So it is I've truly rolled out something for fed up readers that they can access on a daily basis that is a continuation of my mission to spread financial literacy as far and wide as I possibly can.
Oh, that's excellent. I do like the way you refer to yourself as a French pig sniffing out risk truffles. So what risk truffles are you smelling right now?
For me, some of the biggest disconnects in our markets today have to do with individual investors buying into things like leveraged loans. They're like, well, my broker told me that in a rising rate environment, it helps to be in these safe assets. And I'm like, well, let me think here. If you're a junk bond and you cannot gain access to the capital markets, to the junk bond market, because your credit is so poor, then you tap the leveraged loan market. And you're going to have a retail product designed with this as the underlying. It's insane. But more to the point, when you hear the talking heads day in and day out justify the FANG stocks being a third of the S&P 500, they're up by a third over the last year. People don't understand that they drive the train of their index funds and how very exposed they are in terms of concentrated risk. These are the things that worry me. As of June the 13th, Capital One, and I'm not making an advertisement for them at all, but it's because I'm looking for myself and my mother. But right now, Capital One offers a 12-month CD at a 2.25% rate. As of June 13th, that'll pop up to 2.5%. And that works out just fine for me. Thank you very much. I don't want to be one of your brilliant listeners and viewers who thinks that they can time things perfectly. I'd rather just make sure that my powder is dry at the other end of the tunnel. Thank you very much.
Right. I do that with gold. There's just different kinds of gold. And so for me, my dry powder, because I'm not comfortable with the currency circumstance and what do the central banks call for constantly these days, which is more and more inflation. And so that impacts the value of the dollar and my ability to purchase. So I can always convert my gold and my silver into any currency, any good, or any service. The reverse is not true. And that's just the data.
I'm gonna push back and just give a quick primer on why gold has been such an outperforming asset in times of deflation as well. Mm-hmm. And by its very definition, the more debt you pile on, so we used to have 150 trillion coming out of 2007. Now we have 240 trillion today. Every dollar of debt you create has to be serviced. And what people don't appreciate about servicing debt is that the more pennies per dollar that you have to allocate to servicing the debt, the fewer pennies per dollar you have to spend on other things. And that is why deflation has been so frustratingly persistent, because it's been a mirror image of what inflation should be. The irony is that deflation has been what has punished central bankers, whereas inflation is what punished central bankers of the Weimar Republic days. Right. It's not so much that inflation is the boogeyman. It's that over-indebtedness is the boogeyman, and deflation can be just as paralyzing as inflation if you have debt at all, because your debt grows as a factor of time. Deflation is what has put central bankers worldwide into the tightest corner they've ever been in. Yeah. Because if they ever think about normalizing interest rates, debt service would skyrocket to such an extent that the world would be bankrupted.
Well, that's what the Federal Reserve is attempting to do now, running off its, well, I'm not seeing it in the mortgage-backed security area, but starting to run off their balance sheet in the Treasury area and raise interest rates at the same time. I mean,
they're doing it, and it is taking a toll on the emerging markets. There was a seminal op-ed piece from the Reserve Bank of India's, the head of the Reserve Bank of India, that was literally an outward public plea for the United States Fed to stop its quantitative tightening, because it was literally pillaging, killing the emerging markets complex. So the tightening is very real.
Mm-hmm. It is, and it's going to have a huge, huge impact. It's really, I mean, we definitely do live in the most interesting time.
Without a doubt.
So we're going to take some viewer questions, but so this is my last question, which is, what is the biggest takeaway that you want our viewers to get from this interview today?
I want for viewers to understand that the onus is upon them. The onus is upon them to be informed. The onus is upon them to hit mute. I'm not trying to sell a book, because FYI, unless I'm James Patterson, I'll never make a penny as an author. Read Fed Up. Do what you can to be educated. Educate yourself. I don't care if you have to go to the library and check it out. Go get it. Don't rely on other people to do your homework for them. It didn't work in high school, and it doesn't work in real life.
Thank you. You gave me goosebumps, okay? Because that is such a true statement. So now let's take a few questions. John asks, what's the current status of the upcoming reset? And I believe he's talking about the currency reset that the IMF has been talking about for a few years now, or the financial system reset.
As in timing?
Yep, he wants to know the current status. I mean, are you a goddess? You are kind of a goddess.
Yeah, but I'm not stupid. So I'm not going to answer that question. I really have no idea. Italy looked like it was going to blow up. So the markets are having a hissy fit party because they're celebrating Mario Draghi potentially not going through with a taper by the end of this year. It's hard to say. 2017 entailed $2 trillion of record quantitative easing. There's absolutely no mystery as to why markets hit their peak in 2017. We're supposed to be reducing that by half to $1 trillion in 2018. That will not be a friendly development, but you're going to have to get the biggest dove on planet Earth to push through and make good on his word while he's watching Italy potentially blow up. So as far as timing goes, I have no idea, because it has to be central bankers working in concert to push through tightening, not just the Fed.
Right, and there's a lot of disconnect here. So between the Bank of Japan and the ECB and the U.S. Fed, I mean, they're all at different levels. Do you think that means that it could happen anytime, that there could be a crisis that comes out of the blue black swan event anytime? Do you think that could happen?
You know, it's hard to say. You don't know. I cannot stand it when people say geopolitics. I think it's the biggest red herring in the world. But I don't think we need to fall back on that flimsy excuse of saying anything could happen in North Korea any day now. I don't think we have to go there. I think that we can look to what happened in Italy in a period of 48 hours while we were closed up for Memorial Day as enough of a shot across the bow to give us fair warning that something could happen and that we were at a very fragile place.
I think that is a huge takeaway too. I would agree with that. So Articus asks, is there a relevance to having the Fed after this next financial crisis? Will it be terminated?
No, I mean, again, I am public enemy number one for the conspiracy theorists and the people who run around with aluminum foil hats on in the deep of the night.
Right.
China would like nothing more than Ron Paul's dream to come true. They really would. As a matter of, again, national security, China would be like, wait a minute, there's nobody watching the largest financial system in the world. Well, that's good because our banks are bigger than theirs. And Chinese banks are bigger than United States banks. And China would look at it as an opportunity to simply take over the world financial system. Again, my children are taking Mandarin, but I would prefer that we not go down that road.
I think I'd agree with that, since China is also more like a dictatorship, and you know, it's more than communism. Now they just have one person for life and lots of surveillance and lots of interesting things happening there.
And Xi Jinping has told us as much, that he's going to be around for the rest of his life.
Yep, exactly. Well, let's see. Olga asks, if the central banks believe that what is good for corporations is good for labor, how can they hold that true in the face of all the offshoring and robotics?
Central bankers may be deities in some people's minds, but they don't control everything.
No, they don't.
No, they don't. Have their policies exacerbated the need to find cost controls and seek ways to ensure your profit margins don't get smoked in a zero interest rate environment? Yes. But the central bank's not responsible for every single aspect of our evolution. Thank God.
No, but you were also talking about, you know, that because they're PhDs and their popularity and how well they do is based on papers. So they build all of these models, but in real life, none of those models actually work the way they think they're going to work. So that would be the trickle-down theory that he's referring to, and really the wealth part of it doesn't work.
Well, no, the wealth part of it is absolutely broken. And as I highlighted in Fed Up in the book, they actually tried to get a consultant to replicate a certain number of Fed models. And even with the assistance of the original architects, the original doctors and academics who described the models, 51% could not be replicated. Thank you.
That's pretty substantial. Why does almost everyone on a Kitco video seem afraid to, seems afraid to really say how gold and silver should be performing during this market meltdown? Well, I don't think either one of us know what, what the thought process is on, somebody else's video. But you could address that. Why do you how do you think gold should be? Because actually, all right, I'm going to back up here to move forward, because I personally thought that going into this year, particularly with what you were talking about before, all of the rebuilding that had to happen from the hurricanes and then the taxes and the repatriation, that we would just see a continuation of 2017 as basically an up market without the ability to have a pullback. And yet, this market has not behaved the way I thought it would the first quarter into this year. So with that as a backdrop, how would you think that, first of all, it's spot gold and spot silver should, I hate the word should, but it's in there, so I'll say it, should be performing during what's happening in the markets right now?
Well, again, call me a simpleton if you will, but the size of global central bank balance sheets continues to grow. So ergo, gold and silver should remain range bound until that shifts. It's really, again, I'm not trying to be overly simplistic, but it really is as simple as that. Until we get in a true contracting mode, and people need to understand, they need to not hyper-focus solely on the Federal Reserve. Quantitative easing is a global and fungible function. So it doesn't matter where the money's coming from, and it doesn't matter who's printing it. Wash that out of your mind. As long as we just crossed $22 trillion last month, as long as global central bank balance sheets in the aggregate continue to expand, then gold and silver will, by definition, trade in a range.
Yep, I agree with that, absolutely. So that's really the opportunity for people to be buying gold and silver severely undervalued, and that's probably why so many central banks are accumulating it.
Well, that certainly could be the case, but again, I think that central banks accumulating gold has less to do with the value proposition per se, and more to do with trying to prepare for any kind of a geopolitical event.
Exactly. You know, I have so many more things that I'd love to ask you, because it's just amazing for me to be able to talk to somebody that was actually part, and I was always kind of partial to the Dallas Fed and, you know, Richard Fisher, but it's wonderful to be able to talk to somebody that was inside of those hallowed walls and is so busy. Let me tell you, I really appreciate you taking the time, because I definitely do understand just how busy that you are. Is there anything else that you would like our viewers to know about? And we'll put up all the links and everything so everybody will have easy access to all of your services. But is there anything else you'd like to say today?
Well, I would invite your viewers to go on quillintelligence.com. It's very easy. Quill Intelligence. I marry the old with the quill and my writing capabilities with what's to come, and that's intelligence. We were producing some of the best research in the world. It has absolutely no bias, no agenda, and no politics. So go to www.quillintelligence.com. Follow me on Twitter at DiMartinoBooth. It is never boring.
Nope, you are fantastic. Thank you so much for coming here today. And hey, you guys, get this book. I mean, it took me right back. It's so well written. There's so many great things in there. And thank you so much, Danielle. I hope you'll come back on again sometime.
Thank you. I would love to. I appreciate your time as well.
Thank you. Bye-bye. Be safe out there.
Bye-bye.